Welcome to Real Talk. I'm Kathy Dawson with Royal LePage Heartland Realty and Homefield Group. This is my business partner, Rick Lobb. And today, joining us, we have Kelly Williams from Libro. Thanks for joining us today, Kelly.
Hi, thanks for having me.
Off the hop, I guess we just want to know how long you've been in the business and what areas you serve.
Sure. So I've been in the banking industry for just over 15 years, which 10 of those years I have been doing lending and mortgages.
So you must have started when you were like 15 years old.
I did. I started when I was 16 years old.
There you go.
My mom worked at a bank and she thought that I should come work at the bank as well. And I thought I should go to the movies with my friends, but she dragged me in anyway. So yeah, I've started as a student and then went off to college. Worked in the field for a little bit and then decided that I didn't want to work in corrections. So I came back to the bank and I've worked in the bank ever since. So I've did jobs within the mortgage center. So I worked at the central mortgage unit for Scotiabank when I first started. So I had like behind the scenes in mortgages. And then I've been a teller, I've been an investment advisor, an assistant branch manager, a branch manager, and now I'm a home financing advisor with Libro.
Nice. Mm-hmm. And you've had experiences at a number of different institutions. You mentioned one of them.
Yeah.
So you've seen the inner workings of all the major banking or some of the major banking institutions?
Yes.
You're happy with Libro? Libro's
Love it. It's amazing. It's a great company. So yeah, I've been with Libro since May of 2021. So I'm just over a year at Libro and I'm loving it.
Oh, that's great.
Yeah, it's amazing. It's different working with a credit union and a bank. I mean, everybody offers the same products and services, but just the way that they operate is totally different.
If we can just touch on that point, because oftentimes, especially with first-time home buyers, they may not know the difference between a traditional bank and a credit union. Why don't you clarify the difference between the two?
Yeah, so as a credit union, we are smaller. We operate locally. We have 36 branches in southwestern Ontario, but the difference between the credit union and a bank is you're an owner at the credit union, so you buy into the profit, like you profit share with us. You're not just a number. We look at you as an owner, and you grow with us.
Nice.
Wonderful. So recently in the news, we've seen the increase in interest rates, and just curious what you've seen as financing changes for buyers.
Yeah, so we've seen a lot of changes over even the last 6 weeks with the interest rates starting to increase. The markets have kind of slowed and we're not seeing so many competitive offers. So we're seeing more people come in for pre-approvals, which is so important because things have changed so much over the last even 6 months that what people thought they could afford a year ago is not affordable anymore because of the stress test. So it's so important for people to come in and get a pre-approval because you need to know what you can afford. And we don't just do our pre-approvals based on what's affordable on paper. We really sit down with our owners and go over a budget to find out what is affordable to their lifestyle, to what expenses they actually have that we may not take into consideration on the actual mortgage application. So when I'm doing mortgages for my owners, I want to make sure that when I put them into a house, I want to make sure that they can still afford to live, that they can go out, that they can put their kids in sports, that they can still live a happy life and not just have their mortgage payment that they have.
So anyone that's been in for a pre-approval, they are locked into a rate.
Yep.
And then if the rate has increased, that won't affect their pre-approval unless they haven't purchased something within a time frame.
Yes.
How long of a time frame would they be pre-approved for?
So we will guarantee the rate for 120 days. That means that they actually have to come in, do a full application. We'll pull their credit bureau, we'll make sure that we get the full application in, and house has to close within 120 days. So as long as it closes within the 120 days, that would be the rate that they would be guaranteed. So even if rates increase in that time, they're guaranteed whatever they originally received at the beginning of their pre-approval.
Just out of curiosity, in the past year, because of the chaos of the market and how crazy it has been, how many people did you see who had come into your institution and said, yeah, I've bought this house, I couldn't, or maybe I got a pre-approval, but I actually didn't get, I couldn't have a financing condition, so I need a mortgage, here's when it's closing, and let's make this happen now?
So that was happening a lot over the last 2 years. So that's really challenging for us though, because without having a condition to finance, they've signed off on a firm offer, so the house is there, so they have to come up with financing. But say we do need to do a full appraisal on the property and something came back with it, say it was an environmental issue or asbestos or something as to why we may not want to take that property, we're finding that people need to have backup plans. If we don't require condition to finance. It's not something that is mandatory, but it is highly recommended, because if we can't help them, they are going to have to find a backup plan to be able to secure financing.
The good news in all that is that we're starting to see the market balance out, and we're going to see those financing conditions coming back on the majority of offers.
Yeah, exactly. And people were calling us saying well, I can't put a condition to finance because there's multiple offers going in, and I really want to get this house, so what should I do? And as a lender, and I care about my owners and I want them to be successful and I don't want to see anything happen to them, I would try to work with them and try to find a solution. But ultimately, if they're going to sign firm, they just need to know that they have to have a backup plan. And we're going to try our very best to be able to secure financing for them, even without a condition to finance. But if for whatever reason something was to happen, that they are confident that they have a backup plan and that they're still going to be okay, because we care and I care. And I would never want somebody to be in a position where they need to pull out, or if it's say private financing where it's the interest rate's so high that it's so not affordable to them that they're set up to fail right from the beginning.
Right. Yeah, I know as a realtor in that last market, you're on one hand, you need to advise people to be careful and to make sure that they have all their ducks in a row. On the other hand, you have to advise people that if you have conditions in your offer and there's 5 other offers on that property, you're probably not going to win that competition. So there's a fine line that you need to walk between making sure that your client is protected, but also making sure that your client can compete in a multiple offer scenario. Yeah. Now we're seeing those things start to calm down, and it's actually going to be beneficial even for sellers who can be more certain that their buyers are going to be able to close the transaction because they've had a financing condition and have had an opportunity to put all those ducks in a row.
Yeah, exactly. So we are definitely happy that people are starting to put condition to finance in, and we're happy that people aren't having to compete so high for properties, because it can be very stressful, especially for first-time home buyers who, can only afford a certain amount of money, and they're just being outbid every single time. It's discouraging.
It was really discouraging for a lot of buyers.
And it's so hard to keep motivated and want to keep doing it when they just feel like they'll never get one. They just feel so discouraged that it's just not attainable for them. So
for buyers now, good idea for them to come in and have a chat and get that initial pre-approval in place. If they're not ready for the pre-approval, can you give us some tips on what they can be doing to save up?
Yeah, definitely. So it's really important to start saving for a down payment as soon as you can. So what I would recommend is starting a monthly contribution so that it automatically comes from your bank account into a savings or an investment account, and you don't actually have to go in and physically put money into that account. So coming in, doing a budget, we'll make sure that we ask you, what you like to do on the weekends, and like not just your bills and expenses, but also what you like to do for fun, and that we include that all in your budget so that when we come up with what amount is affordable to start putting into your savings account or your investment account, it will allow you to be successful and not have to go back and draw from that account so that you can do those other things. So definitely starting a monthly savings is super important. It can be as little as $25. It doesn't have to be a lot of money. It's whatever is affordable to you, but doing it on a weekly basis or monthly basis, it just allows you to, save without even really knowing that you're saving, because it's just coming out of your account automatically.
Great. And tell us a little bit about a credit check, what a buyer can expect and how they can improve their credit score.
Yeah, for sure. So I'll just start by talking what a credit score is first. So a credit score is a 3-digit number ranging from 300 to 900 that gives a lender a snapshot of your financial health. Lenders use credit scores to be able to figure out how much they're willing to lend to an owner. The higher your score, obviously, the more you may be able to have.
Like the borrowing power.
The borrowing power, yeah. The higher score, the higher borrowing power that you're going to have. Things that might hurt your credit score is missing payments, maxing out your credit cards, closing credit cards because it will lower the capacity that you have, shopping for credit excessively, opening up numerous accounts all at one time because that could show that you're having financial difficulties, having more revolving loans than installment loans, and borrowing from finance companies can also hurt your credit score. So things to improve.
Sorry, what was that last one?
Borrowing from finance companies.
Oh, okay.
So, yes, depending what finance company it is, but some of them can hurt your credit score. And how to improve your credit score, you can pay down credit cards and try to keep the limits below 75% capacity. So by doing that, sometimes people think that the lower credit that they have, the better. But say you had a credit card for $1,000 and you put a trip on it, it's maxed out at $1,000. It's actually hurting your credit score instead of helping, even though you're paying it off each month. So having limits, but staying 75%, like only using 75% of your credit.
So on that note, then, don't get a $1,000 limit, get a $10,000 limit, and keep everything low that you borrow under $5,000 or $7,000, and that will actually.
It will help your credit score, but I would be cautious with doing that. You have to be responsible with your credit as well, because obviously the higher credit that you have available to you, you may want to use it.
Right, the temptation is there.
The temptation is there. But yes, if you had a higher credit limit and only used a very small portion of it, it's actually helping your credit.
That's interesting.
Yeah. Continuing to make your payments on time and slow down on opening accounts. So don't open a lot of accounts all at the same time, and ensuring that the information on your credit report is accurate. And also another important thing to remember is if you are shopping around for a mortgage, if you do it all within like a 2-week period, it will count as one inquiry. But if you do it over a 2-month period, it would show each individual inquiry, which will hurt because the more inquiries that you have, it lowers your score.
Really? They don't see that as somebody shopping?
They do, but it will
around?
lower your score because it's over a longer time frame. So if it's in a short time frame, it won't hurt your score as much with the inquiries.
It's good to know.
Yeah, so those are just some of the things that can hurt your credit and help your credit.
Thanks for joining us today, Kelly. We really appreciate it. This is Kelly Williams with Libro, and that's Real Talk.
and you'll find her here in
Thank
Goddard.
you. Yeah, thank you.